Welcome to the special show where we bring you an all-round analysis on the ongoing Russia-Ukraine tensions and its impact on the market. The Indian markets remained weak for a fifth day on the trot after tension between Ukraine and Russia intensified following a fiery speech by Vladimir Putin. Putin's long-drawn speech ended with the signing of a decree that immediately recognized the independence of two separatist regions in Ukraine which are dominated by Russian-speaking people. The economic consequences are already visible in stock market correction, higher crude oil and gold prices. Now, globally, stocks have been hit in recent days and investors have rushed to safe haven assets amid rising worries over a potential conflict in Eastern Europe. And we're here to analyze what exactly is it that's spooking investors and what should you do amid the rising uncertainty. We've got a stellar lineup of experts joining us today. Market maven Shankar Sharma, Peter McGuire, the CEO of XM Australia, Santosh Nair from CNBC TV 18 and Manisha Gupta from Moneycontrol. Guys, thank you so much for touching base. Santosh, I'll come to you first. What exactly is worrying the market so much? Yes, Russia-Ukraine tension, there's been a fair amount of back and forth there, but overall, what are the big factors according to you?
Well, for the moment, it's the crisis at the Ukrainian border, but more than that, I think it's the fact that money is getting tighter, money is becoming more expensive, interest rates are going up globally. In India, for now, the RBI has not signaled higher rates, but given the trend globally, it players here say that it's just a matter of time before interest rates start rising here also. Already you've seen global crude prices going up, which is a big negative for India. Secondly, inflation has been on the rise and you saw that affecting the margins of most companies in the quarterly earnings just gone by. So valuations are expensive, you got interest rates going up, inflation is a worry, crude prices are going up. So all this put together, you have very weak sentiment. So Ukraine is just a kind of a trigger at this point, but there are more longer term worries.
So all possible parameters, I mean, everything that can go wrong, I think, is playing out right now. But let's say there is a full-blown attack. What happens then to the markets? We're already witnessing a fair amount of jitteriness, right? So what worse can we expect?
Well, the market would have some cushion from inflows into mutual funds because a lot of money is now coming through SIPs. But a lot of money also has been coming through first-time investors, and a big chunk is also coming through high net worth investors who are regular traders. I think these two sources probably would take a hit. So far, we've seen consistent FI selling, but thanks to good domestic liquidity, somehow the market has been holding up. But as the selling, foreign selling intensifies, I think clearly you're seeing some pressure that could accelerate. Also, some bit of money could go out of the system because of the LIC, upcoming LIC IPO. That's a fairly big numbers, around 65,000 crore.
Badly timed also.
Yes, that is the overall size of the IPO. But remember that almost it draws in about 4 or 5 times that money, at least for the when the issue is open for subscription. So you could see some bit of liquidity crunch there also. All these factors right now are playing on the minds of investors. Most importantly, what investors are saying is that people have started questioning valuations in many cases, at least for second line companies.
The big question, the whole point of today's special show for our viewers is to give them something that they can act upon. So right now, those people who are already invested in markets, many of whom are new investors who've entered post the pandemic, what should they do with all of this volatility? Because up until now, everything was hunky-dory last 1.5 years.
Right, Karunya. So, if you've got SIPs going into mutual funds, it's best not to touch it. But at the same time, you also need to kind of reassess your portfolio, because many of the first-time investors have not really seen what a bear market is like. I'm not saying we're in a bear market right now, but they would not have seen this kind of steep fall that we've seen over the last 2 or 3 months. So it's time to reassess your portfolio. Look at the stocks which have been underperforming for quite a while now. If they have fallen much sharper than the market, probably you need to get out of some of them. Look at the rest, look at the fundamental factors. If you feel that these stocks have fallen just about as much as the market and their fundamental earnings theory is still intact, then probably you can still hold on to them. But as for many of the mid-cap names which went up just because the market was rising, I don't think any of them are going to be near their all-time highs anytime soon.
Well, we have a supporter of mid-cap and small caps joining us later in the show as well. So I'll ask him what his view is, because there is a fair amount of risk there and a lot of volatility that's playing out as well. Any big red flags or any value picks which the street is talking about right now amid especially the broader markets?
No, I think right now everyone is trying to find safety in frontline stocks. That's where most of the, because even where consistent money is coming in, a lot of it is going into exchange traded fund and index funds. So clearly there is some support there. So I think you could see some bit of these frontline stocks holding on for some time. That's a safe haven for now. Other than that, it's anybody's guess.
All right, Santosh, thanks much then for joining us with your insight on what's going on in the markets. Let's take it across to Shankar Sharma as well. Then Shankar, thanks for joining us today. Let's start with the biggest event that's unfolding right now, the Russia-Ukraine tension. How will markets react, let's say, if there is, a proper attack on Ukraine?
So every war of this kind will result in two things: the market sell-off, and there is a flight to safety, so treasuries might rally. And the third thing is that oil prices typically spike up in such cases of geopolitical tension, where there are places where large amounts of oil are found, which is really obviously Russia. So any conflict of this kind will have these three effects. So what we are seeing right now, it is pretty a standard, let's say, recipe for what happens in case of war or near war situations.
And where do you see India in all this?
So India will suffer. India is not given, is some gifted country which cannot suffer the ravages of a global market rout. We are right in the middle of it. Even though Indians believe it, we are not on the same earth as the rest of the countries. The reality is we are just another country, just another market, which has good things and bad things. And in a bad situation, we will hurt as much as any other market will.
As we speak, there was a fair amount of downturn today also in the markets. Nifty did, fall about 2% during the day. Over the last 6 months as well, we've largely been in a range-bound sort of a trade. Millions of new investors entered in the market in the last 2 years, and they're not prepared for these volatile moves. For them, the stock market was this bullish place which only goes up, as you also mentioned in your tweet. So what's your advice then to these new investors now? What should they do?
They should welcome it. They should embrace it. They should kiss it if they could kiss it. Because these are the invaluable learnings on a journey on a long journey, hopefully for most of them in investing, that you have to take the rough with the smooth. Markets are not going to be permanently bullish. And when they're bearish, they become brutally bearish. Their markets defy logic in terms of how far prices can fall. So everything in theory, when people look back and say, okay, market fell and then rallied, when you are undergoing that, when you're living that every second of the day, tick by tick, that's the real learning you take away as an investor or as a trader. So they should love it. They should not feel bad about it. They should thank the market for giving them this wonderful learning opportunity in which a huge amount of tuition fees will be paid by these little investors to the market. Hopefully, they will recover all of that back through these learnings over a long period of time.
Last week, a quote of yours was doing the rounds where you said 70% of Sensex stocks won't go anywhere, and you were asking people to bet on small caps. As of this afternoon, Sensex was down 2%, small cap index lost 3%, and you may be right that small caps lead to bigger gains and bigger compounding. Whenever we are, though, going through an uncertain period, volatility hits the small caps much harder. So how does one deal with this volatility while patiently waiting for these stellar returns to turn up?
Yeah, so I mean, whoever said that investing is an easy game, it becomes easy for some time. So when you go to a casino, okay, the casino makes you win the first few games. That's the way it is set up, especially the good casinos will got a lot of data. And then one day and one fine hour, the game turns and you suddenly give up all that you gained and you give up more. That's the way the stock market is. I'm not saying it's a casino, but ultimately still a series of bets you take. Now, if you're taking a bet on Hindustan Lever, and if you took that bet in 2020 March, you were the most foolish person in the world because the stock did precisely zero. Same with the banks and same with the most other FMCG companies. But if you were taking a bet on the small caps, you made five times, 8 times, 10 times your investment, right? Therefore, you are going to be forced to take additional risk in order to make additional return. And that area of the market is the small cap market. And in such situations, that will be the area of maximum damage because they have done the best in the last 2 years' time. Now, if you've watched market for 30, 35 years, you know this is part of a script. Nothing that is happening is unexpected. What gives you maximum pleasure will give you maximum pain. That is my favorite quote, and is a quote given, or invented by me. I'm very proud of it because that really captures the essence of market, that what gave you maximum pleasure, for the small caps, they're going to give you maximum pain, but the cycle will come back to the better companies there. And that's exactly where you're still going to make 5x, 10x of your money. You're not going to make that buying HDFC Bank or Hindustan Lever.
So any of these small caps that have caught your eye amid the ongoing correction then?
Oh, there are many, many stocks. I mean, again, in small caps, it's a vast market. You have to fish carefully because, there are a lot of all kinds of dodgy companies. I would think more than 90%, 95% are dodgy companies. You might find 4, 5, 8 good companies if you're lucky. If you do a lot of work, if you travel around India, meet companies, get it from your network, do a lot of channel checks. All those are essential ingredients of making money in small caps, where you need a lot of informal sources of information. By just looking at a balance sheet, you will not get enough information. There has to be a very 360-degree approach to looking at such company, which is labor intensive. I always said that making money in the stock market is not easy. It looks easy for a while, but it's never on a long-term basis that simple. Okay. And therefore, it will require more effort by investors to get to those 4, 5, 10, 15, 20 big winners. But they are right here. They are in the market. They might be falling 5%, 8% every day. They might fall a maximum of 50%. I think they'll be great buys.
So, if we talk about volatility, today the VIX, India VIX was up 21%. And keeping this volatility, uncertainty in mind, which sectors would you suggest that one must keep out of and the ones where people can invest in right now?
I think IT services continues to be if you talk a broad, well-established sector, looks great. Without any doubt, those companies have great visibility, great management, whether large or mid or small cap IT. Choose wisely, of course. But with that caveat, I think that's a great place to be in. Chemicals continue to be a very, very attractive place. China plus one is very real. A lot of capacities will move to India, are moving already. That's a great place. So these two old line established sectors are extremely attractive. And then there are newer companies doing little small things here and there. Somebody supplying to some EVs and all that. There are, little pockets, which again, you have to choose carefully. But those pockets will also make you decent money if you bet wisely on, let's say, 4, 5 stocks in that space. So there is plenty of choice in the market. Let me not give another picture. Contrary to what is the reality, I think the choices are immense.
You spoke about tech, you spoke about new companies, but what about new age tech companies? Because they've taken quite a beating in the recent past. So what's the view there?
Well, first they made victims of retail investors. Now they are becoming victims themselves. So what you sow is what you reap, as the saying goes. So I think it's okay. They sold their stock at crazy valuations. And I repeat for the nth time, it's all credit to them. They did a fantastic job of creating a good story, a good hype, good momentum. Sold stock, which is what their job is, to investors, whether QIBs or FPIs or DIIs or retail investors, जिसको हम लोग बोलते हैं हिंदी के माल पहना दिया ऊपर में. अच्छा किया ना, माल पहनने के लिए आ रहा है तो पहनाना ही चाहिए ना. What is the big deal in that? So, they did a wise job. They did a fantastic job. And now the stocks are correcting. It's not their problem. The problem of the guys who bought them.
Okay. Both metal and realty sectors, now these are the two packs where we get a lot of questions as well from our viewers. They've seen a sharp fall if you compare them to other sectoral indices. Should one remain out of these right now? And if they've already invested, should they book profits, whatever they're getting, and exit immediately? What do you suggest?
I mean, I'm not a big fan of metals at these levels. I bought them in April, May 2020 when they were just coming out of the cycle, oil and steel and all those things. But, we exited, I think by March, April last year, we were pretty much out of it. We've never gone back into steel at all, even though numbers are very, very good. These are very, very cyclical businesses. And, at least our read was that the cycle has more or less peaked out. Or even if it's not peaked out, maybe we are one year away from peaking out, and which is good enough from my perspective. If you make 2x, 3x in a metal stock, that's more than what I want to make in these kind of companies. As far as real estate is concerned, I think the broad story in India is intact. Money will find its way from the stock market to the real estate segment. It has been unloved for a very long time. Barring, such volatility as we are encountering right now, I think well-chosen real estate plays will give you decent returns.
Gold is back, crypto is down. I know you're not someone who's very averse to cryptocurrency. You've already said in the past that one could look at a 3 to 4% of exposure, when it comes to digital assets. The Bitcoin gold comparison is perhaps as clear as it can be in today's situation. And just 2 days ago, there was a Grow survey that 45% hinterland investors are looking to deploy more money in cryptocurrency. What do you think about crypto, and what is it about cryptos that attracts Indians so much when the stock market has been around for so many decades?
I think it's just a new asset class, and anything new will be embraced by people who are younger rather than people who are older. I mean, that's axiomatic, right? That older people will say, this is all rubbish. And now we know a lot of my, fellow investors, my dear friends have said there's all rubbish. And even in the US, the old guys have said it's all rubbish, but that's their perspective. Newer guys will adopt and adapt to change much quicker. So they like crypto as more their asset rather than their grandfather's or their father's assets or their mother's asset more appropriately. And therefore they flock to it. Doesn't mean gold is going to go out of business or that crypto is also a scam. I don't think either is true. Both will remain, both will occupy a certain place in people's portfolios. Particularly for Indians, I think most people will still prefer gold for the perceived safety of it. But the newer age investors will say, no, I want something easily traded. I want something which has volatility like crypto. I can buy at 20,000, I can sell at 30,000, I can buy again at 15, I can sell at 25. Gold, you can't do all that. That's more a stable long-term store of value. So different markets and different people, it's just like two products for different segments of the investing class.
Okay. All right. Couple of more questions before we let you go. What are you most excited about the markets right now, and what worries you the most at the moment?
So what is worrying is their excitement is there permanently in a good way or a bad way. Okay, so that's part and parcel of the fun of being in investing and markets. What is worrying me is that...
Is it that's worrying right now?
Yeah, so what is worrying me right now is whether all the easy money policies that started after the GFC of 2008, and that cycle ran for 10, 11 long years, successively fueled by, rate cuts, moderate hikes in 18, then again rate cuts after COVID. Whether that whether there's going to be a complete reversal of what we have gotten used to, which is really easy money, cheap money, abundant liquidity. That is what is at the back of my mind, that have we gotten too used to this drug of easy liquidity and at a very low price, that the withdrawal effects of that will be very, very severe. I mean, that is what is my back of my mind. That is what is worrying me.
Okay, then, well, thank you so much, Shankar, for joining us and for sharing your insights and your reading of the market as it's playing out right now. Joining us now is Peter McGuire, the CEO of XM Australia. Peter, hi, thank you for waiting by. How are you guys reading into what's going on across the key global markets? What is the, sense you're getting?
Well, Karunya, a couple of quick things. I think the massive move to the upside as far as crude over the last matter of, say, 24 to 48 hours has taken everyone by surprise. So we're knocking on the door. I've got the screen here. We're knocking on the door of 100. I think the mood as far as sanctions being imposed or certainly talking about from numerous European nations towards Russia are going to be that's going to be very interesting how that plays out. We've got a war strategist, as we know, Mr. Putin, and you've got the overall nervousness, US equities and global equities, I'm feeling will have a continued softness. So that's what every trader's looking at, and a stronger US dollar at the moment. I think 96.2 for that US dollar index will probably creep up a little bit further.
Peter, I have a question for you. So in the overall emerging market landscape, where does India stack against, let's say, China, for instance?
Well, if you're looking at equity markets, I think it could be a sell-off for a number of those. So I don't think anyone's going to be immune from it. From a dependency as far as oil prices, I think India will feel it more than China in a lot of ways, in the sense of price at $100 barrels of oil, or if it goes up to 110, that's certainly not a good point for any emerging market, and certainly no country like India. So I think that's the story there. We've got ratcheting up as far as rate rises this year in 22, and the Fed with two hands on the wheel saying, are we going to see 7 rate rises? So all of that factors in with higher energy costs, higher gold prices, more uncertainty, and I think, higher food prices across the globe. So 22 is going to be a very, very interesting year, a volatile year and a dynamic year from a trading perspective.
Can this war tension make markets like India more attractive to foreign investors?
I think they'll make them more attractive. I believe, and no doubt the global strategists believe and investors believe that India, its decade and really its century, we're right there now, that sweet spot. So overall demand, the brilliance of not only the nation, but it's an incredibly young population, and the rebuilding of cities and motorways and infrastructure. So the storyline is one, I think, a very much blue sky for India, and it positions so well for this decade and really for the next decade onwards, as long as commodity prices don't outprice themselves.
Okay, Peter, do you see the FII trend improve? I mean, from October until Jan, things were quite bad as far as Indian landscape was concerned. Feb onwards, yes, things are looking up a tad. But how do you see the trend playing out? Any any word on that?
No, I don't. I think that just the overall consensus is that there's going to be nervousness across a lot of markets, that there's a sense of, I think, trepidation from the retail investor. They've had an enormous rally over the last year and a half to the upside, and everyone's made money hand over fist if you've been a trader. So at the moment, I think it's just a little bit of nervousness sweeping across pretty much the world. Interest rates rising, as I mentioned, higher energy costs, food costs, and sell-offs as far as equities that could continue in the short to medium term. So these storylines as far as war really create, I think, a lot of nervousness to investors and certainly to nations. Let's not forget 48% of Chinese demand, or pardon me, European demand for natural gas comes from Russia. So that's not a good sign to put sanctions on them, especially in winter.
Right. Okay, Peter, great getting in some perspective from you as well as far as the global setup is concerned and how India could be viewed amid all of what's going on. Thanks for joining in. But Peter was talking about a host of commodities, how things are playing out in the commodity space. Manisha joins us for that. Manisha, crude oil is above $97 a barrel. So is $100 just a psychological number now?
Oh, well, absolutely. I would say that, yes, $100 is just a psychological level now to watch out for the crude oil prices. We already have done more than $97 per barrel there. But yes, most global banks, brokerages do believe that it is going to be between $100 to $125 per barrel in this quarter, in the first half of this year. And that is because of the kind of concerns that we're looking at. It already is a tight market. We are looking at lower global inventories. The production from shale gas hasn't picked up as well. The OPEC production, even as they have been increasing their agreed quota for every month, they haven't been able to pump up the production. And then you have the geopolitical concerns, and Russia is an important state at that, because Russia is the second largest producer and second largest exporter of crude oil in the world. 12% of global crude export comes in from Russia. And with the kind of worries that we are seeing building up against Russia, the kind of sanctions that US is talking about, that there is going to be no new investments, no new trade, and there could be sanctions on companies and individuals there, could really hamper supplies going forward. And then it is all not just US, you have European Union, UK, you have France, Germany, all of them talking the same language. And it really is a long drawn, stretched, concern that we are looking at right now. And it could continue to support the crude prices. Markets also believe that the second half of this year could see some decline in prices. We could even go down to 85, 90 kind of levels, not too far away from where we are right now. But yes, a peak, if you may want to call that, for the next 2 to 3 years would be created in the first half of this year.
While, crude is making a fair amount of headlines, Russia also is an important metal player, and metal prices are also at decadal highs.
Oh, well, absolutely. Russia is a big one when it comes to metals as well. And two metals that should be on your radar right now are aluminum, which is trading at a 13-year highs, and nickel, which is trading at a 10-year highs right now. So I will take it one by one. Aluminum is trading at around $3,300 per ton there. And when you look at Russia, it is the second largest producer of aluminum. Nearly 6% of aluminum comes in from Russia. And when you look at ex-China, 13.5% of global aluminum comes in from Russia. And yes, with the kind of sanctions that we are working with right now, and the fact that we already have seen 1 million tons of a deficit in the previous year, that could increase to 1.3, 1.4 million tons of a deficit again in this year. There are concerns coming in from the second largest producer of aluminum there. And you have a similar situation coming in for nickel. 10% of global nickel comes in from Russia yet again. Norilsk Nickel is one of the major, biggest companies there when it comes to nickel. For nickel as well, we are looking at almost $25,000 per ton of prices right now. Nickel has gained up 9% in this month. It has gained up by 29% in last 1 year as well. And nickel as well is looking at much lower global inventories, near record low inventories in the Shanghai exchanges. And both of these metals are energy intensive to look at. They both have supply concerns coming from Russia, and they're both used in green energy, the energy transition, the EV that we are talking about going forward. So with lower inventories and the kind of concerns we are working with, these are a couple of metals that you absolutely should not go short into. These are the couple of metals that can see further gains from here on.
We missed out on the precious metal as well. The portfolio advisors in the current scenario of high inflation, geopolitics, are they now looking at gold with respect again?
Oh yes, there has been that safe haven buying that we have seen in case of gold prices. Trading at a 1-year highs, and $1,900 per ounce has been taken off. So when you look at this year itself, it has been very strong gains. In the month of December last year, we were trading at $1,750 per ounce, and we are trading above $1,900 per ounce right now. So it has been $150 of a jump that we have seen in last 3 or 4 months already come in case of gold prices. And yes, portfolio advisors and financial advisors are telling you that gold should be a part of your portfolio, especially given the inflation concerns we're looking at right now. The investment, because also the equity markets are selling off, that seems to have also money seems to be coming into gold as well. And the geopolitical, well, gold is a safe haven, for all of these places here. And we also have seen a spillover effect come in for other commodities. Silver, for one, is trading at a 1-month highs. Platinum and palladium, again, Russia is a major producer for both of these metals as well. These prices also are trading at a multi-week highs, and the spillover also has come in for other agriculture space as well. Other industrial commodities, for example, you have cotton prices which hit an all-time highs in this year itself. You have rubber prices trading at a 38-week highs. You have palm oil, which again is because of a biodiesel concern and crude prices going up. Palm oil is trading at an all-time highs. You have rice trading at 19-month highs. So, well, yes, there is a big impact that we have seen come in for commodities because of Russia and Ukraine. And the markets do believe that this can last yet another couple of months, and then we will take it from there. There could be some consolidation, but no, nobody's telling you to sell any of these commodities at these levels.
All right, Manisha, thanks for that. Well, there you have it, a 360-degree view on what you should be doing with your investment right now and how you should be reading into market volatility amid the ongoing Russia-Ukraine conflict. Thank you so much for tuning in. For more updates about markets and everything else business that's playing out, keep it with the YouTube channel of Money Control. Thank you for tuning in once again.